The most dangerous weapon in the Gulf isn't a missile, it's uncertainty. And right now, that weapon is heading straight for your bank account. This morning, the war between the United States and Iran has entered a new phase, not because the Strait of Hormuz has been officially closed, but because 9 consecutive nights of U.S. strikes and Iranian retaliation have turned this narrow waterway into a permanent source of global economic uncertainty. What changed over the last 2 weeks is that attacks on tankers, warnings from the UN shipping agency, and sustained U.S. Central Command operations have pushed the conflict beyond visible explosions into a long test of whether the world's most important energy corridor can stay open, insurable, and affordable while missiles keep flying around it. The core event behind tonight's analysis is straightforward. On July 7th, U.S. forces began new strikes on Iranian targets after Iran's Revolutionary Guard was accused of attacking 3 commercial vessels transiting the Strait of Hormuz, shattering what little remained of a fragile understanding between Washington and Tehran. Since then, Iran has claimed or been blamed for missile and drone attacks against U.S. military sites and partner infrastructure in Bahrain, Kuwait, and across the wider Gulf region, while the U.S. has answered with waves of air raids hitting more than 80 Iranian targets, including air defense systems and command networks. On July 20th, U.S. Central Command launched a 3-hour 9th wave of night strikes aimed at defending commercial access to the strait, confirming that this is no longer a short burst of retaliation, it is now a campaign. That campaign is not just about bases and batteries. It is about whether global shipping can still cross one of the world's most sensitive choke points without turning every tanker voyage into a high-risk gamble. To see why this matters far beyond the battlefield, you have to look at the way this war has changed the rules around the Strait of Hormuz. On a map, the strait is a narrow throat connecting the Gulf to the wider ocean. In reality, it is a central artery for a major share of globally traded oil and liquefied natural gas. When missiles are launched near that artery, the target is not only the steel of a ship or the concrete of a terminal. The target is the confidence that allows tankers to move, insurers to write policies, and markets to believe that tomorrow's deliveries will arrive on time. Renewed attacks on shipping have already killed seafarers and led the UN's maritime agency, the IMO, to issue urgent calls for maximum restraint and de-escalation, warning that the cycle of escalation must end before more lives and more cargoes are lost. The important point is that you do not need a formal blockade to create an economic shock. You only need enough danger to make every actor in the chain, captains, insurers, traders, and central bankers, start pricing in fear. What we are watching here is a classic commitment trap. U.S. leaders argue they cannot accept a world where Iran can dictate which ships cross Hormuz and under which conditions, especially after attacks on commercial vessels. Iranian leaders argue they cannot accept a reality where American bombers and drones can strike their territory, restrict their ports, and effectively control their economic lifelines without facing costs in return. So the response from each side has been to demonstrate resolve. The U.S. surges sorties, night strikes, and naval protection. Iran broadens its retaliation to include military and infrastructure targets across the Gulf. Regional governments report alerts, interceptions, and damage as the conflict spills across borders. The more each side proves it will not back down, the more the danger grows that this war becomes less about specific attacks and more about who has the authority to write the rules of the Gulf. To understand why this matters far beyond the battlefield, we need to follow the chain from missiles to money. Energy economists and central bank researchers have been modeling scenarios where partial disruptions in Middle Eastern oil exports push prices higher and ripple through global inflation. We are now living one of those scenarios in real time. Brent crude has climbed back toward the high 70s per barrel, meaningfully above pre-war levels around the upper 60s, and futures curves suggest that prices are expected to remain elevated into the end of the year. That price is not only about the barrels themselves, it includes a conflict premium for shipping through Hormuz. When that premium rises, the first institutions to move are traders and insurers. They do not wait for absolute catastrophe. They react to trends, more missile news, more UN warnings, more military flights, more uncertainty. Here is how that shows up in daily life. A tanker operator is told that war risk insurance for crossing Hormuz is now multiple times more expensive than it was before the latest wave of strikes. That extra cost is passed along the chain, first to the energy buyer, then to the refinery, then to distributors. Transport firms pay more for fuel, airlines pay more for aviation fuel, farmers pay more to run equipment and transport crops. Manufacturers pay more to heat plants, move goods, and purchase raw materials that depend on energy. Consumer prices respond slowly but surely. Gas at the pump rises. Flights become more expensive. Electricity bills edge higher, especially in countries that rely heavily on imported energy. This is the hidden war tax. It is not voted on in Congress. It does not appear as a special line on a receipt, but it quietly transfers part of the cost of a distant missile exchange into every household budget that has to buy fuel, food, or electricity. For retirees and older Americans, that hidden tax lands at a difficult time. After several years of inflation pressure, many were hoping that 2026 would finally bring a clean path toward lower interest rates and more stable prices. Now, Federal Reserve discussions and regional Fed analyses are signaling that volatile oil markets and shipping risk have clouded the outlook again, with projections that headline inflation could run closer to 3% before gradually easing instead of sliding smoothly back to 2%. The Fed faces a serious dilemma. If it cuts rates too quickly while energy-driven inflation is still strong, it risks undermining confidence in its commitment to price stability. If it holds rates higher for longer, borrowing stays expensive, housing affordability suffers, and the government pays more to service a large national debt. In both cases, retirees have to think not just about the nominal value of their savings, but about what those dollars will actually buy if inflation stays stubborn. This is how a night raid over southern Iran can reach a mortgage renewal in the Midwest or a retirement planning meeting in Florida. Higher rates mean higher monthly payments for those who need to refinance. They mean tighter credit conditions for small businesses that rely on loans to expand or simply survive. In the stock market, higher for longer interest rates tend to hurt rate-sensitive sectors like housing, utilities, and some consumer stocks. At the same time, defense contractors and energy producers may benefit from increased military spending and higher commodity prices. Gold and the dollar can both rise as investors look for safety, while bonds initially rally in flight to quality and then come under pressure as inflation and debt concerns resurface. None of this is automatic, but the pattern is clear. As long as Hormuz remains a risk zone, the path to cheaper credit and calmer markets gets bumpier. Behind the immediate strikes lies one of the most important operational questions in this war: ammunition and sustainability. Reports from defense sources and media coverage suggest that since the conflict intensified, Iran has fired hundreds of ballistic missiles and thousands of drones and cruise systems at Gulf targets, forcing the US and its partners to expend large numbers of advanced interceptors and air defense rounds to protect bases, cities, and shipping. The exact numbers are hard to verify independently, but the logic is easy to see. Every Patriot or THAAD interceptor launched over Bahrain or Kuwait is one that cannot be used elsewhere. Every sea-based missile fired from a U.S. ship to defend a convoy is one more round that has to be replaced in a production system already under strain. Military production is not like flipping a switch. Factories that build complex missiles and interceptors require specialized parts, trained workers, secure supply chains, quality control testing, and multi-year contracts. You can surge some output, you can add overtime, but you cannot triple production overnight just because politicians want it. That means each conflict imposes an opportunity cost. When Washington chooses to fire more advanced munitions in the Gulf, it has to think about what that means for commitments to Europe, to Asia, to Ukraine, and to other allies who depend on U.S. systems for deterrence. The risk is not that America runs out of weapons tomorrow. The risk is that sustained consumption in one theater reduces flexibility in another and pushes planners toward either more restrained strategies or more aggressive moves designed to end the conflict before inventories become even more stretched. Financial history is a reminder that military strength has limits when it runs into economic reality. The Suez Crisis in 1956 showed that Britain and France could win tactical engagements and still lose strategically when financial pressure and diplomatic isolation forced them to back down. Today, the United States holds a much stronger position than Britain did in the 1950s. The dollar is the world's main reserve currency, and U.S. markets remain central to global finance. But the principle still matters. You can win battles and lose ground in the bigger picture if the costs keep piling up through higher debt, larger interest payments, and a slow erosion of confidence in your economic management. As U.S. defense spending rises to sustain operations and replenish stocks, Congress will need to decide how much more borrowing is acceptable and at what point higher yields demanded by bond investors start to crowd out other priorities. The international response to the Hormuz crisis has now moved beyond statements. The UN Maritime Agency has condemned lethal attacks on tankers. At least 2 seafarers have reportedly been killed, and the agency's head has even urged a halt to transits in the most dangerous zones to protect crews. That is extraordinary. The idea of slowing or pausing movement through one of the world's main energy arteries, even temporarily, shows how far this conflict has pushed global systems. Gulf states are stepping up defensive measures, monitoring routes, and quietly exploring mechanisms for shipping verification and phased de-escalation that could, at least in theory, reduce risk without granting either side a clear victory. China and Europe are watching closely. As major energy importers, they know that another step up in Hormuz risk could send prices and political pressures surging inside their own borders. For the United States, this is also a test of domestic patience and political clarity. Wars are easier to sustain when the public understands the goal. Right now, commentators and officials are debating what success looks like. Is it simply keeping Hormuz open? Is it reducing Iran's ability to threaten shipping and regional energy infrastructure? Is it pushing Tehran back to the nuclear negotiating table? Is it weakening Iranian missile capacity for years to come? These goals are not identical. If leaders cannot explain which outcome they are willing to accept, it becomes harder for voters to understand when the mission is complete and for markets to price in an end to the premium on oil, shipping, and risk assets. When you turn down the volume on the rhetoric and look at the structure of the situation, 3 realistic scenarios emerge for the next stretch of this war. In the first, controlled but costly confrontation, the strait remains open but risky. Shipping continues under heavier protection and higher insurance costs. Oil retains a conflict premium. The Fed and other central banks delay or soften rate cut plans. Defense and energy stocks outperform more vulnerable sectors. Volatility remains a feature of markets, not a bug. In the second, dangerous escalation, a major tanker loss, a large energy facility strike, or a deadly hit on U.S. personnel triggers much harsher moves. Shipping volumes drop, insurance dries up, oil prices spike, inflation jumps, and both stocks and bonds suffer together as growth expectations weaken and yields rise. In the third, negotiated pause, Gulf diplomacy and international pressure produce a limited arrangement to protect shipping and energy sites, give crews safer routes, and create space for talks. Oil loses part of its risk premium. Inflation expectations improve. Central banks regain some flexibility, even as the deeper political conflict remains unresolved. We also need to address some of the misleading narratives already circulating. One common claim is that this is just another symbolic flare-up that will pass without real consequences. The facts say otherwise. Renewed attacks have killed crew members, triggered formal UN condemnation, and forced serious discussion about halting some transits in the world's key energy choke point. Another claim is that the US has everything fully under control because of its military superiority. American capabilities are enormous, but they do not change the basic arithmetic of risk. As long as Iran can threaten shipping, and as long as every tanker crossing Hormuz carries a war risk surcharge, the economic side of this conflict remains messy and costly. A third narrative suggests that because no nuclear plant has been hit and no formal blockade declared, nothing truly systemic has happened. That misses the point. Economic systems often break not from a single dramatic blow, but from long periods of uncertainty that force households, companies, and governments to adjust in ways that compound over time. So let's bring this home to an average American family. Maybe you are not following every headline from the Gulf. Maybe you are just noticing that gas prices are a little higher this month, airline tickets look more expensive for the fall, and your 401k has been swinging more than usual. You might hear that the dollar is strong, that treasuries are still considered safe, and that American energy production is a buffer against the worst shocks. All of that can be true, and yet your cost of living still rises because conflict risk is being priced into the global system. The goal of this analysis is not to amplify fear. It is to make sense of the stakes, that what happens around the Strait of Hormuz is not an abstract contest between distant militaries. It is a set of decisions that can change what you pay at the pump, how fast your grocery bill grows, and how stable your retirement savings feel. The chain is straightforward. War risk raises shipping costs. Higher shipping costs raise energy and production costs. Those costs sustain inflation. Persistent inflation delays interest rate cuts. Higher rates weigh on housing, stocks, bonds, and the government's ability to manage its debt. That is how a missile launched near Hormuz can eventually influence a mortgage payment in Ohio or a retirement account in Arizona. The missiles get the headlines. The uncertainty sends the bill. So I'll leave you with this question. Do you think this growing pattern of strikes and counterstrikes is making America safer or pushing us toward a more dangerous and more expensive world? If you want to follow how days like this show up in your gas prices, your savings, and your sense of security, make sure you're subscribed to Professor Jiang Shuiqin Classroom and share your view in the comments. Do you believe this conflict will stay contained, or are we drifting toward a wider regional war?